Audience, a very good evening to you all. Beyond 2020, 25 happening careers in accounting and finance in association with Prime Academy welcomes you all to a webinar on how about a career in equity research. This is the fourth of our webinar series. The first three were on how about a career in forensic accounting and fraud investigation. The second was on how to prepare for a global career. And the third one, which happened yesterday, was on how about a career in enterprise risk management. I hope you all are enjoying our webinar sessions and are being enriched with the information provided by the experts. Now, uh, it is pleased and a blessed moment to have an expert who is someone special in this webinar, who has an experience of 3 decades in this field of equity research. He's a cost accountant from India. He's a certified financial analyst, and is also a certified financial risk management professional. After working for many organizations, is now a managing director at Marmor Mena Intelligence, which is a subsidiary of Mercus Kuwait. I'm sure with his knowledge, experience, and wisdom, we all will be enriched with the information in equity research. Ladies and gentlemen, with a big hi in your chat, please welcome MR Raghu, our expert for today's program. Raghu, we welcome you all for today's program.
Thank you so much, Ibrahim. I truly appreciate this great opportunity and wish the program very well. Thank you.
Thank you, Raghu. We look forward for your experts' insights into this webinar. Now, let us introduce the anchor for today's session. He is very famous in the student fraternity and also amongst the practicing professionals. He's a practicing chartered accountant at Yoganand Ram. He's a seasoned trainer. He's an author who has written many books. He's a public speaker and a trainer as well. Ladies and gentlemen, with a big hi in your chat box, please welcome CAV Pattabhi Ram as an anchor for today's session. And I would like to hand over the control to Pattabhi Ram. Sir, over to you.
Thank you, Ibrahim. Good evening, Raghu, and good evening to all of you who have chosen to be here this evening. It's lovely being with Raghu. I've known Raghu, I think, from the early 1990s. He's a very sharp brain when it comes to equity research. More importantly, he's a very sharp brain when it comes to making investments. And I'm sure all of us are going to be immensely benefited by his presence. To the audience today, to those of you who tune in later, I must tell you that the objective of today's seminar is to talk to you about what is equity research, to provide you with insights as to what is the scope of work, what are the skills that you need, what is the kind of educational qualifications you must have, what is the pay package that you can expect, and what is likely to be the road ahead in equity research. When we first formulated this a few weeks back, I never thought that we would ever talk about a future for equity research. Now that COVID has struck, I think there's a need to talk about that as well. All the talking will be done by Raghu. Compared to our three earlier webinars, we have changed the format this time. Earlier, we used to have a conversation throughout. This time around, Raghu will speak first. He'll do a 18 to 20 minute presentation on equity research, and thereafter, on the basis of the questions that you have already put out, plus what you will put on the chat box here, I'll put across those questions to Raghu. That's the broad format. Raghu, it's all yours for the next 18 minutes.
Sure. Let me upload my presentation. Okay, can you see the presentation?
Perfect.
Okay, great. Good evening, everyone, and thank you, Pattabhi and Ibrahim, for the kind introduction. I've been a student of finance for a while now, and though I started my career as an accountant, I quickly changed course to equity analyst. And ever since I've been in the investment banking industry, wearing a equity analyst cap. I try to follow markets. I try to write research reports, and it's a very interesting. I love the field of equity research. So this presentation, I'm going to be uh, uh, wearing an educational hat of apprising you as to what this function of equity research means and how to pursue this as a career and what type of options do we have. And then I'll be more than happy to answer the questions. So who is an equity analyst? Basically, an equity analyst is a person who arrives at an investment decision based on some analysis. Uh, analyst can be any analyst. He can be a credit analyst. He can be a health analyst. So an equity analyst, as the name implies, is more concerned about investing in equity stocks. So whatever he does finally, should result in telling himself or others as to what to do with a particular investment idea. How does he go about this job of analysis? So there are some components to it. The basic components are what we call as the fundamental analysis. So you can do a top-down or a bottom-up. The most preferred would be top-down. So you start with the broad economic analysis, and then you zoom into a particular industry, and then within that industry zoom into a particular company for more analysis. So why do we need the broad economic analysis? Because the shape of the economy shapes the fortunes of many industries. So one should be a very good economist to become a good equity analyst. So there is no two ways about this. And if you don't have interest in economics as a subject, I think you will find the going tough as an equity research analyst. The industry, you have so many industries to crack, starting from, say, banking to FMCG to information technology to chemicals. So it depends on if you have a particular, you have a particular educational background in engineering or science that lends itself to that particular industry, that would be a head start. Otherwise, you can pretty much master any industry of your choice based on your interest. But then when you come down to the company level, then you have hundreds and thousands of companies to look at. So this is where it gets very quantitative and very analytical. And there are many tools, including financial modeling, segment analysis, valuation techniques, comparable analysis. So it's a big science by itself, but nevertheless very interesting. So normally analysts use what are called as stock screeners. So we have in India, we have more than 7,000 stocks listed. So it's pretty much impossible to research the entire universe of stocks. So you apply some basic screening. So you weed out companies that are loss-making, you weed out companies that are small, and you weed out companies that don't have liquidity. So you have screens. And when you have screens, then you reduce the universe from 7,000 to probably 70. 70 is an easy number to look compared to 7,000. So we have a lot of tools, including tracking the news at an economy level, industry level, company level. We track the performance of the companies, and then you come up with your research report. Now, this is basically the function of an equity analyst. So what it involves is basically research, where you try to read a lot of annual reports, meet the management, attend conference calls, attend industry events, and then form an idea. And then once you form the idea, you try to model that into your Excel. And you now have to crunch numbers to see how historically this company has done. And based on your discussions and analysis, what is your prospective projections for this performance of this company? This is the most important element of an analyst job, to get into the future of expectation rather than past performance. And then you also have to be articulate enough to say your thoughts very well. And write that in the form of a research report. And either when you cover a company for the first time, it's called an initiation report. And when you follow up on companies, it's called an update report. So a lot of analysts just specialize in a couple of industries and even a handful of companies to really master their analysis. Now, in terms of an equity analyst, there are two types of equity analysts. The first type is called the buy side, and the second type is called the sell side. I think this is a very important difference to understand. The buy side are the people who make the investments. Like, for example, a good example would be mutual funds. Mutual funds invest their money in companies and stock markets. So the analysts who work for a mutual fund are called buy side analysts. On the other hand, when you have a sell-side analysts normally work for brokerage firms. And their idea of research is to generate interest in the stock more than help an investment decision making. So they are supposed to be giving a recommendation of buy, sell, or hold. And based on that, when a particular analyst from a sell-side brokerage firm comes up with a buy recommendation, then this buy side institution gets to read it. And if they are convinced with the logic of the sell side analyst, they trade through the broker. And that's how the broker makes the money through commission. So the sell side research is more of a marketing exercise, and the buy side research is more of an investment exercise. One is not superior to another because the brokerage industry is also huge and the institutional industry is also huge. But the brokerage industry has a lot of marketing pressure, whereas the institutional research on the buy side do not have such marketing pressure. So you can choose to be on the buy side or you can choose to be on the sell side. Now, what do you need to become an analyst? Of course, you need basic qualifications in finance and or economics, business management, accounting. So it's pretty much the basic academic qualification can be broad, but then you need to choose one professional qualification to append to your basic qualification. For example, if you are a chartered accountant, then you can be a chartered accountant, plus you must pursue a chartered financial analyst course, which is considered to be the gold standard for equity analyst. Or there is another course called Chartered Alternative Investment Analyst, CAIA. This focuses only on alternative asset class like hedge funds, private equity, real estate. And there is also a very popular program called Certified Financial Planner. But financial planning is more operates at a retail level. And of course, there are many chartered accountants who also pursue the role of equity analyst without pursuing any professional qualification. By sheer practice and number of years of experience, they become trained analysts. Plus, the regulators in each country also offer certain certification programs, and it depends on which country you live in. You can pursue those regulatory certifications, which sometimes can be mandatory in the industry that you want. But pretty much, I would, say that the most preferred choice of qualification would be the CFA qualification. It is considered to be one of the toughest in the world. It has 3 levels, and it takes roughly about 3 years to finish. And the way employers recognize a CFA in a company is certainly very good. So once you join an investment bank, obviously this is going to be a huge plus for anybody who wants to pursue a career as an analyst. Now, okay, you have done your qualification, you have your CFA or you have your CFP, and then you work as an equity analyst. Now, it's not the end, it's a beginning, because, it's as much qualitative as it is quantitative, in the sense that your experience over time will come to play in terms of observing the intangibles and, how to identify the quality of management. think that is a very important aspect of an analyst job. Also, I think it will be a good idea for an equity analyst to look for a mentor. He can be a senior analyst or a senior portfolio manager. And in days like today's world, where LinkedIn enables you to network seamlessly, all you have to do is just request for someone to act as your mentor. Now, what do they do as a mentor? The mentor, constantly gives you advice on your career, and he shares his experience. He listens to you, and probably tells you the do's and don'ts. Now, why do you need a mentor? The mentor is not your immediate colleague or a superior or a junior in the firm. He is somebody who is outside the system. So he doesn't have any vested interest, and he helps you because he thinks, it's a professional thing to do and help. But I don't see many people asking for a mentor and engaging with the mentor continuously. I think this can change the world for you if you can identify a good mentor and engage with him constantly. And as I said, analysis and investing is as much a creative and intuitive process as it's analytical. So years of experience should definitely add to that. And this profession of equity analyst involves heavy reading. You must be reading like crazy. You should read annual reports, you should read newspapers, you should read industry reports, and then you should bring that to some sort of a model that you can apply, show, and argue. So that means a lot of reading. And you also have to introspect regularly to see how your calls are done, where did you go wrong, and what are your strengths and what are your weaknesses, and you have to constantly refine the process. And finally, if you are an equity analyst, you should be very patient because the results are not going to come tomorrow. So there is a huge amount of learning involved here, but the upside is enormous, and one can really take the chance. Just to give you a perspective on the Indian equities, as you know, our equity markets are divided into size. So there are companies which are called large cap. They are simply large companies measured in terms of market capitalization of 3 billion or more. And then you have mid caps, middle companies with market cap ranging between 1 to 3 billion. And then you have small caps, which is probably greater than 100 million. So you can see that the number of stocks in the research coverage is disproportionate, and it is more in favor of small caps, because the universe of small caps is simply too big. But if you see the stocks covered by analysts, it's probably 96% falls in the large cap. And also bulk of the analysts are engaged in a large cap company analyzing, because large cap companies are, good names like Asian Paints, Infosys, Bajaj Auto. So there is a lot of institutional interest in these stocks, and the work done by an analyst can be put to use immediately. So you can see that more analysts cover large cap than small caps. For example, for every large cap company, we have 25 analysts covering a particular stock like Infosys. Whereas in the case of small caps, we have only 7. So, it's not that you should start with the large cap and end with the small cap, or start with the small cap or end with the large cap. It's just that, what interests you can, because the way you analyze small cap is completely different from the way you analyze large caps. Large caps are more information efficient, follow better corporate governance policies, are more professional and organized, and are more approachable. Whereas the small caps are normally family-run businesses, not so very professionally managed, not so efficient in terms of information sharing, and ethics quotient is also very low in small cap companies. So if you are an analyst pursuing a small cap, you must have a very different orientation of analysis compared to an analyst pursuing large caps. Career opportunities are plenty for an equity analyst. He can get employed in leading investment banks like Morgan Stanley, JP Morgan, and they are the best investment banks, pay the best money. And then you can find them engaged in stock brokerage firms like ICICI Securities, Motilal Oswal, some of them, but there are many of them. And then you can be employed with mutual funds, as I said, on the buy side. You have so many mutual funds in India, hundreds of them. You can also get employed in private equity firms like Carlyle, Secua, Blackstone. Private equity works very differently in terms of a business model compared to public equity. They are not listed, and therefore the due diligence is much more rigorous in private equity. An offshoot of private equity is venture capital firms. They are not as big as private equity, but nevertheless, they are at a very low end of the value chain of companies, mostly dealing with the startups. And then you have KPOs, which are called knowledge processing outsourcing. And they are specialized in supplying research as a service to investment banks and stock brokerage firms. So they are an outsourcing agency, and we find a lot of analysts working for them as well. Analysts are also employed in credit rating firms, but credit rating analysts mostly focus on the credit side and fixed income side rather than the equity side. And then you have family offices that manage the wealth of families. And they are not many, but they are very big. We have given some examples here. So the pay potential depends on your experience, and the base salary starts from annualized 4 lakh Indian rupees to up to 30 lakhs for experienced professionals. And typically a person works as an equity research analyst for 4 or 5 years. Then he gets promoted as a portfolio manager. And when someone becomes a portfolio manager, obviously, his salary and bonus is much, much higher compared to analysts. So it's a very lucrative profession, but a very demanding profession. So this is the brief overview about what is the role of an equity analyst and how to become one and where to get employed. So I'll stop here and probably start taking questions, and if that is okay, Pattabhi.
Raghu, can you stop sharing your desktop?
Yeah. Okay.
Ibrahim, I have the questions. Some questions I picked up from what the audience had asked. I'll start with them. Raghu, I must first compliment you. I think that was a very, very measured and well delivered talk. There are a few questions. One of the earliest questions that came in was that when talking about the EIC framework, you said that the equity researcher must master the industry. Our viewer wants to know, what do you exactly mean by the word master the industry?
More than mastering the industry, I am keen on mastering the economy.
Okay.
I emphasized on the economic side of it. I said that you should have a deep interest in economics as a subject, and all equity analysts are by default economists. Because if you miss the big picture, you will miss the small picture as well. So the economic analysis is very important. If you are able to forecast, for example, interest rates, or if you are able to forecast inflation, or if you are able to forecast capital flows, then you can really make brilliant calls. But then finally, when you have an economic call, and then you should come down to industry choices. So there are some 10 or 12 interesting sectors in India, and the most important one would be the banking and financial services, followed by information technology, followed by automobiles, and then you have FMCG, you have consumer discretionary, chemicals. So there are so many sectors to choose from. You cannot be a master of everything. So you have to choose a particular industry, for example, information technology, And you must relate your economic idea to that particular industry. And then you will become more familiar with what are the big names in the industry, what are the small names in that industry, and what are the competitive dynamics of that industry, how the business model of that industry works. And then you specialize more and more and more. And then you start approaching the companies. In US, for example, sector analysts are a most sought after breed because for every sector you have a star analyst, and he moves the market. So whatever he says, suppose he gives a sell recommendation on a company, you can see that the next day the company's stock tanks because the market values the opinion of that particular analyst. So
Raghu, sorry,
yeah.
you named a few industries. You began with BFSI. You talked about technology industry. Were they just examples, or are you saying that these are going to be good industries in today's market?
No, they are just examples. So you can pretty much say choose paints as an industry of your specialization, okay, and then you can become a paint analyst.
All right. There is another question that has come up which says you spoke about buy side investing, you spoke about sell side recommendations. Which is the space in which the best equity analysts are, or in other words, which one of these two should an equity analyst actually select?
Yeah, if you are a buy side analyst is like an unsung hero. Okay, his work normally goes unpublished because he does the research and he provides his recommendation to his investment committee or to his portfolio manager, and the portfolio manager makes a stock decision based on what his analysts say. The sell side, on the other hand, they publish reports under their name and with their recommendations. So, you get to gain popularity over time. And you have to, your agenda of covering a particular company is to generate interest among institutions to trade with you. So, people view sell-side research with some sort of a skepticism because they know that there is a hidden agenda, and you have to overcome that, and you have to show your professionalism, and then you have to gain confidence among your constituency. But it's more of a marketing exercise compared to hardcore analyst that happens at a buy-side firm.
I think Ibrahim wants to make some announcement at this point in time, and then we will come back. We've got a few questions for you to answer.
Sure. Mm-hmm.
Thank you, sir. It's a good going. We have been receiving questions from the audience. The talk has been very interesting because it's giving valuable insights into equity research. I would like to just make an announcement that we have an upcoming webinar tomorrow as well on 30th of May at 5 p.m. Indian Standard Time. The last of our webinar series, which is on how about a career in business process outsourcing. Our expert for tomorrow's program would be Krishnan Ramachandram, who is a global head of R2R and lead robotic process analytics at Royal Philips. So stay tuned to our social media platforms to know more about the updates on the upcoming webinars and other information. Thank you. Over to you, sir.
Yeah. Raghu, there was a question. I'm combining two of them. Question number one, is CFA mandatory to make a career? One. Two, would an MBA from one of the top 10 do? And is it necessary even they have to go to doing a CFA? That's the question that somebody has.
It's not mandatory by any stretch of imagination. For example, if you take the global analyst world, CFAs are only about 10%. Oh, so it's not definitely mandatory, but it's a feather in your cap. So it's a highly competitive industry. Remember, an MBA still is a very broad-based program. And whereas a CFA completely focuses on research, analysis, and portfolio management. So that's why it is so much more valued. And when you get into an investment bank and or a mutual fund, you will obviously rub shoulders with fellow CFAs, and there will be a peer pressure for you to acquire this qualification, because they are much more valued in the industry than other qualification, because it's considered. The Economist magazine calls this as the gold standard of equity research. So obviously, uh, nice to have. If you ask me, do you need to have? No, you don't need to have. I mean, if you master things on your own, why not? I mean, you can 90% of the world works that way.
Would I be right if I say that in a crowded world, you would be able to stand up in the crowd if you had?
Exactly. So,
There
and
is a
if you're a young professional and you are still in a study mode, you might as well aim this and finish it.
Correct. There is a question that is apparently from a young CA. He says, what should a young CA or what USP should a young CA have in order to get into equity research?
A questioning mind.
Okay.
The basic trait of a good equity research analyst is he questions everything. He doesn't take anything that he reads at face value, especially if he's a chartered accountant. He knows how reliable or unreliable financial statements are, and he knows how notes to accounts are more important than the broader income statement and balance sheet. He knows the importance of the link between profits and cash flows, for example. So, there are many subtle ways in which companies send out messages. And an analyst's sharp brain should be able to capture those subtleties and transform that into investment recommendation. If I can give you a small example, recently, last year, there was an analyst who covered a company called OM Group in US. And when he covered the company, he was so, appreciative of the earnings growth of this company, and he recommended the stock to his management, and his management subscribed to the stock. And the stock was doing very well. It was reporting earnings growth quarter after quarter. And then he attended some conferences with the CEOs and the CFO, and he was not getting very good vibes about the company. The company, took him on a massive conference presentation, but they never said anything forward-looking, and they were trying to be good, but not necessarily useful. And then he started digging into the notes to accounts, and then he found out that this company actually has been showing very good earnings growth, but has not been showing any cash flow. And when he queried and further researched deeply into that, he found that this company uses a particular accounting method of LIFO compared to FIFO for inventory calculation. And this is a specialty chemical company that is into a particular chemical called cobalt that is available only in Congo country. And the cobalt prices have come down severely. And if you employ LIFO, then you take last in, first out price, which is the lower price, and push the higher price onto the inventory. So he found the red flag, and he didn't find the management to be very open. He didn't like the way they explained his questions. And then he came and gave a sell recommendation on the company. When he gave the sell recommendation, the stock was priced at $70. And the moment this analyst gave a sell recommendation, the next 3 months, the stock price fell to $5. So you can imagine the power of analysts, how they can influence the stock prices and how they can be, ahead of the curve in terms of finding out problems in company. So the biggest trait, apart from the basic ability to analyze financial statements, would be your inquisitive mind. As this analyst asked one very simple question: if you are having such good earnings growth, why is not showing up in the cash flow? So the company could not answer that question, and when we dwelled deeper into it, he found that they just used an accounting trick to show earnings growth, but they really don't have any cash flow to sustain that earnings growth. So it's inquisitive mind that can make you a good analyst.
Raghu, there is a very interesting question. I think it's a fallout of the kind of headings that we often see on the internet. Uh, a viewer wants to know what is life in a day for the equity analyst. In other words, what does an equity analyst do in a specific day?
Well, it depends on your work habits. And, when you get wed at your work, you don't know the time. So you can see, normally I see in my office in Kuwait, analyst working late at night. And he's just got so interested that he can't take his eyes off his computer. So there is also a very, celebrated analyst who in US, I think he wrote a book, The Big Short, something like that. So he spent, reading all the SEC filings for 3 years. And then he went short on this insurance stock, and then he made $1 billion. So, imagine someone reading 3,000 pages every day for so many months in order to connect all the dots and then take the decision to go short on a particular stock. So it's basically your work ethics, but I always recommend a good work-life balance because you should observe the world as well. You should not just be sitting before the computer and modeling all your life. There are portfolio managers in India that I know who go on road trips to discover India and therefore discover companies. So this is what Peter Lynch, the most celebrated portfolio manager, did. He was never in his office. He's always on the road, meeting companies and enjoying talking to suppliers, dealers. So that is how he spent his life as an analyst. So there are many models. It depends on how you want to structure your work life, but don't get burnt out. The biggest problem with equity analysts, especially working for investment banks like Goldman Sachs or JP Morgan, is that they get burnt out. And I've even known cases of suicides. So because they are not able to keep up with the peer pressure. So this can get as bad as this. So that's why I keep emphasizing on work-life balance. Take your mind off. Maybe you will get a spark when you take your mind off. And if you focus on your computer, you may never get a spark.
Raghu, can you suggest a couple of books that people might want to read to get started? I do know that what matters is practical experience than text, but nevertheless to get ideas, get concepts beyond what they possibly read when they do their chartered accounting. Is there any specific book? You were talking about Lynch. So are there any specific books that you would want them to read?
Yeah, everyone reads a lot about Warren Buffett, but I don't think we have another Warren Buffett in the world, even though hundreds of books have been written about him. There are many good books to read, especially one concerning the investment world. But recently I'm reading a book called Good Strategy, Bad Strategy. I am really enjoying that book because it tells how companies sometimes don't even have a strategy and they mistake their goals to be strategy or their activities to be strategy. And the examples they give are beautiful. I also I enjoyed reading a book on top 10 CEOs and how they have excelled in the ability to allocate capital and made billions of dollars for their shareholders. So, as I said, read. And if you go to my website, I have a library in which I have showcased all the books that I've read in the investment world. And they're all sort of classics. And, it's good to be constantly reading. Some not necessarily related to your industry or company, but something that is more macro. because you have to always see everything from a macro perspective. I think that can make a huge difference in terms of the calls that you are making. So, for example, in every industry, you have good companies and you have bad companies. And every good company may not be a good stock if it is expensive. And every bad company need not be a bad stock if it is available for a penny. So, for example, recently you would have seen the stock fall of Idea Cellular. This company from 200, 300 rupees fell to 2 rupees, 3 rupees on bad news. And from there, it recovered now to so smartly on the news that Google is talking to Vodafone to collaborate. So you have to be constantly on the watch out. Even the example that I gave before on OM Group, where I said that the stock fell from $70 to $5, but I didn't tell you one thing. Subsequently, the stock recovered from $5 to $40. So, you have to be constantly, watching and reshaping and analyzing and reading. Otherwise, you will miss the trend and you will miss the opportunity. So, what to read? There are plenty of books to read. I normally go with the recommendations from Financial Times on the best books to read for
Or
the
Raghu,
year.
maybe you can you can tell us what is your blog. They will go to your blog.
Yeah, my website is my name, mrraghu.com.
All right.
And if you can go to that, there is a section on a library section where I archived all the books, and you can even find the Amazon link to those books with my comments on what I think about those books.
Wonderful.
Reading should be a very, very integral part of your life as an equity analyst.
That's wonderful. Raghu, one other question. This is no, I do not know whether the connect is right, but I'm reminded of Peter's principle, which talks about every guy moving up to his level of incompetence. Should every equity analyst actually aspire to be a portfolio manager? And before you answer that, maybe for our audience, you might like to tell them what's the distinction between the two of them. And do you think that all equity analysts should one day become a portfolio manager?
It's the eventual hierarchy. Like every junior accountant that joins a firm as a management trainee eventually wants to become a CEO of that company, right? So that's an aspiration aspect, but it's not possible because you may have hundreds of analysts, but you have only few portfolio managers. What is the difference? The difference is analyst role is recommendation oriented. So all they do is they analyze and tell the portfolio manager what they think about the particular stock. And then the portfolio manager is the one who eventually invests in those companies. And he may or may not take the inputs of the analyst. He might have his own analysis and he might have his own rationale of buying or selling a particular stock. He might view a particular stock in a portfolio context. He might have several other aspects to investing. But inputs from his analyst is taken as a very critical input because he works very closely with them. So the responsibility of a portfolio manager is far higher because he is like walking on a knife. He has to perform better than the index, which is the benchmark. And if he doesn't perform better than the index, then he will lose his job. So, it is a much more riskier to become a portfolio manager because now you're on performance block. Whereas if you're an analyst, you can analyze anything and give your opinion, take it or leave it types. So in US, some analysts spend their lifetime as analysts. And some of them go on to become portfolio managers. You might even ask me a question, what happens after portfolio manager? So if you are a portfolio manager for about 5 to 10 years, then you automatically become a chief investment officer of a company. So it's called a CIO. So what happens after CIO? Then you become the CEO. And then what happens after CEO? Then you can aspire to become the chairman of the company or get inducted into the board. So the hierarchy is always possible to jump from one layer to another. Start small, think big.
Okay, that's good. Raghu how has, there are two parts to this question that someone has put out. How much has equity research changed from the mid 90s to today in terms of the way that people conduct research or in terms of the availability of information that conduct research? The second part of the question is the inevitable question is has COVID 19 hurt the way that we would do research in the future? Or more specifically, how do I translate quantitative information that I today have in making qualitative judgments in the COVID era?
Okay, what has changed in the research spectrum over the past few decades? I think the tools are the same. But what has happened is that the technology growth has enabled us to look at more set of data than just the financial reports. So in the past, if I am an analyst, all I have is the financial reports of the companies and maybe a management meeting where they may or may not say much. But now there are hundreds of ways by which you can cross-check your information. And this is what is technically called as alternate data. Like, for example, when you analyze COVID, you have something called as a Google mobility chart. So the Google actually gives you real time, the mobility pattern of people, in residential, in various other sectors. So the sectors where the mobility is coming down and the sectors where the mobility is going up. So everything is controlled by technology these days, and you can use the same technology and look at alternate data to corroborate your findings. So that's a very important development that has happened. COVID will definitely have a major influence on how we work, but will it be anything that will change the way we research companies? I don't think so. COVID has affected the underlying company's performance, but in terms of an equity research analyst, he pretty much has to still use the same old techniques of analysis to really take a call on the company. Only thing is now he has to, when he does a fundamental analysis of a company, he has to see what is the demand side and supply side impact on the company because of COVID. And then he has to adjust his forecast accordingly. We all know that Q1 for many companies is going to be, almost zero. And then you are estimating some Q2 recovery and then a bright recovery for Q3 and Q4. So because of COVID. So the analyst has to incorporate this pattern into his projections and he has to come up with his analysis. But in terms of tools, there is not much of a change. He has to still use fundamental analysis and he can probably embed that better with alternate data analysis using technology.
All right. I think Mohammed Ibrahim wants to make an announcement, and after that, I think I have one or two questions that we close out.
Thank you, sir. Audience, we would like to let you know that all these events are being conducted by Beyond 2020, 25 happening careers in accounting and finance in association with Prime Academy. We are basically about to release our book on this topic. So this is a work of 8 chartered accountant professionals who's been led by Pattabhi Ram, a seasoned author and professional. They have come on a mission to deep dive into top happening careers in accounting and finance. They have met industry professionals and they have gathered information and conducted interviews with them. And a audio podcast has also been released on Spotify and Anchor for a couple of chapters. You can watch them on these platforms. We are about to release audio podcast, an ebook, and a printed version with our publisher Notion Press. So stay tuned to our social media platforms: Facebook, YouTube, Instagram, Telegram, and Anchor to know more about this book. Looking forward for your interest and follow-ups. Thank you. Over to you, Pattabhi, sir.
Raghu, one question. Don't tell me that you cannot answer this question. We would like to know what three stocks that you would want people to buy today?
I would pretty much buy anything
Everything
because
is available for a song now.
everything is beaten down to death
Okay.
because of COVID.
Okay.
And if I have the money, I'll just buy all nifty companies without any bias.
Wonderful. That's
So,
interesting. So would that mean true? But why are the mutual funds buying left, right, and center now?
depends on the inflows. Only if they have new subscription can they buy.
Okay.
But investor psychology is the reverse, right? All the time.
Okay.
When you are supposed not to panic, you panic.
Correct.
And when you are supposed to exercise caution, that is when you throw caution to win. So right now, mutual funds are, including foreign investors, are exiting India. And COVID has created the biggest pressure on emerging markets where foreign investors withdrew about $100 billion, which is the highest in the history of financial markets. So you only have sellers, you don't have buyers. Everybody is panicking. Mutual funds are getting redemptions. And in this environment, people who has cash is king. So, if you have another 3 years to 5 years outlook, all these blue chip companies that are part of Nifty 50 index, be it Bajaj Auto or Infosys or Reliance or Bajaj Finance, you have every big brand, Asian Paints, they're all Britannia. I just cannot stop. Okay, they're all available for a literal song, if you may ask, actually.
I
So there
think
is no big challenge in stock picking in today's world.
wonderful, wonderful. I think there are quite a few people who have very much liked your answer because they are very, what should I say, excited by the fact that an analyst like you has said that there are stocks available for picking at a time when everybody is being cautious, people saying that don't invest at this point in time. Raghu, one quick last question. Uh, Somewhere down the line, you made a reference about small stocks, large cap, medium cap, small cap. You also made a reference about the issues that small cap companies have in terms of transparency, multiple other things. Uh, Someone has asked the question, is it not true that small caps give the greatest opportunity to make the highest returns? Would you like to take that?
Yes, in CFA, 101, this is what they teach you. Higher the return, higher the risk. So obviously, small caps provide the biggest upside, but 9 out of 10 can fail. So this is your biggest problem. But that one can make up for the loss of 9 by miles. Remember, today's Google or Apple or Infosys, they were all small caps to begin with. And so every company starts their journey like a newborn baby. Everyone has to be a newborn baby before they can become adult. So, but the mortality rate among small caps is so high. And small caps, have a problem sharing information. Small caps don't have a good corporate governance structure because they're mostly majority held by a particular family. And, small caps normally face more competitive pressures than medium-sized companies or large companies. So their pricing power is also low. So it's that much more work, to find good small cap companies compared to finding good large cap companies. So, but if you are making an investment for the next 20 years, probably I would say that you must invest only in small caps. You should never invest in large caps because the probability of a stock becoming from small to mid to large in a 20-year time frame is very high, provided you do your homework and research very thoroughly. So, for example, if I take 10 large cap companies and I do a very, thorough research, I might end up investing in at least 6 or 7 of them. Whereas if you take 10 small cap companies and do a thorough research. Remember, doing research, the time commitment is the same, whether it is large cap or the small cap. You might end up only investing in one or none. So it is that much more work, to research small cap companies compared to large cap companies. But the upside is huge. But at the same time, you should also be prepared for meeting huge losses. As I said, high return, high risk. There is no escaping this fact.
One final question, Raghu, before we hand over to Ibrahim. This is essentially intended to be a career advisory kind of program. You have any one piece of advice that you would like young boys and girls with respect to their career when they embark on a career in equity research?
Yeah, it doesn't matter if it is a career in equity research. For any career, I think the differentiating factor is the extra commitment that you show. That is not expected of you. And this is where you make a difference from others. How do a management trainee eventually go on to become the CEO of a company? Very simple. From the beginning, he would have shown extra commitment to work that was not expected of him. I think this can really make a huge difference. You can join a company and do what you're told. Okay, this is what 9 out of 10 people do. You can join a company, do what you're told, and also do what you're not told, but which can add value to the company. So this is called extra commitment. So, for example, you can read something and you can observe a best practice that you like, and then you can go and recommend that to your company saying, I've observed this, why can't we try it out in our company? It was never expected of you to say this. But when the idea is good, the company will say that, wow, this is a guy who is showing extra commitment to his work. I think it's the extra commitment that can take you to places at any. This is a generic career advice, not just for equity research. Any career that you embark, always think what is that extra commitment that you can show to your employer.
Thank you very much, Raghu. That was wonderful. I will now hand it over to Ibrahim.
Thank you, Raghu sir, for coming, accepting the invitation, and then giving an informative and useful presentation and answering the questions of audience in a very detailed manner. I'm sure that this has been an enlightening session for all of us on equity research today. Thank you so much once again.
It's always my pleasure. I have the highest regard for Pattabhi, who's been, as he said, we have known each other for decades now, if not more. And it's always good to share your experience. And I must say that I am equally interested in learning because it never stops.
Thank you, sir.
Thank you.
We would also like to thank Pattabhi sir, who's at his always usual best in making the session lively and interactive with his interesting questions. And finally, to all of you who have come down, listened to this session, asked interesting questions, and definitely we will share this presentation with you through an email. And looking forward for your presence and participation for our webinar tomorrow. Thank you. Thank you all.
Thank you. Have a wonderful evening.
Thank you.
And stay safe.
Thank you.